Hi, this is Carol Williams with Strategic Decision Solutions, and today we are talking with Hans Læssøe. Hans, you want to say hi?
Hi, I'm here.
And
Hans, I apologize for the dim image, but at this point in time when we're talking here, it's 5 p.m. in Denmark and it's winter, which means it's pitch black.
Yep. Well,
Sunset
it is. It's 11 o'clock my time. So that just goes to show you that conversations are very easily held wherever you are around the globe. Yeah. So thank you so much for taking time to talk with us today, Hans. So wanted to talk today about risk appetite and how those concepts can exist within a company and different ways that companies can look at it based on the needs and the culture of the organization. So I know you have a model that you like to use. So before we get into the details, let's just talk through what does that model look like and what is the typical requirements that a company would need to have in place to be able to use that model.
Yeah. Well, the model is actually splitting the risk universe up in different sections. The amount of risk that you can be exposed to can be unlimited, totally, wherever, how big it must be. But there's a limit as to how much you can survive. So if you're hit by X amount of risk, could be $100 million, whatever. If you're hit by that, you're dead. Sorry, guys, but you're bankrupt, you're dead, you're finished. That's your risk capacity. Generally below that, you decide you're not going to take that much risk. You're going to take some risk, quite a lot perhaps, but you're not going to take that much. So you decide how much risk are you going to take? How much money would you put into a single investment? How big investments or how much would you invest in a different area? What would you do moving into Afghanistan or Africa, or how would you do that? You put limits, and you have that all over the company anyway. I mean, you have limits as to how much money can a senior manager or a director or a vice president or senior vice president spend before he has to escalate to next level or even the board of directors. So we have all these ranges, and that's your risk tolerance using the ISO terminology. If you use the COSO, it's risk appetite, unfortunately, but if that's a risk tolerance, that's how much risk you are prepared to take in pursuit of your other value. Now, below that, there's a risk appetite, and the risk appetite is what you're willing to take. This is one called COSO, called tolerant, but yeah, nevertheless, your risk appetite is what you're willing to take. This is what when you're willing to buy a lottery ticket for $1 or 5 tickets for $5. You don't care about the $5. You're buying that opportunity of winning for an amount that you don't care about. You're in a company, you have risks that this may go up or down by 1%, or this can cost you $5,000 or $10,000. Yeah, so what? You're not going to do anything about it. That's below your risk appetite. And when you look at that, you have the different areas and say, anything that's above your risk capacity, you have to control that. You have to mitigate that in some way or form. Okay, that's where you need the risk management. Then you have what's below the capacity, but beyond your risk tolerance. These are risks you have not accepted. You will not accept them as they are. So here again, you need controls, you need mitigations, you need to do something to get them down to where you can be acceptable. The next level is between the risk appetite and the risk tolerance. This is not risk management. Here you don't need risk management because you have accepted that you are prepared to take these risks in pursuit of value. However, that doesn't mean it doesn't make sense to think about them and say, can we do this better? But that's process optimization. It's not really risk management. If you buy an insurance for a carpool, if you have a carpool in a company, you have 5,000 cars, and you buy an insurance for those cars, that's process optimization because you know some of them is going to be broken. I mean, it's just not which ones, but that's the part. So you can optimize your exposure, you can optimize your costs going through that. So that's process optimization. And then we have the risks that are below the risk appetite that you don't care about. Don't ever, ever touch these. Because every minute you spend on those, you take away from something more that may be important to the company. You're wasting time looking at those. And it goes both ways. It's not just about negative risks. You can say you have a company and you have some competitors. There's a risk that one of your competitors go bankrupt and suddenly you can grow 80% 1 year from another. Sorry, dudes, you don't have the manufacturing capacity to deliver the goods. And you have decided, or you don't have the capacity. You can't. It's beyond your opportunity or your lever capacity. You have decided that you will have capacity that can exceed your grow your sales 20%, but not 40. Okay, so if it's above 20%, within 20%, that's within your lever tolerance. That's just what you're prepared to invest to meet. Beyond that, it's so rare, we're not going to invest. We're not going to take that hurdle. So it goes both ways. It's not just about negative risk. It's also about what I more often call levers, the positive things that may happen. But you can control that. So this is the approach I have to deciding where are the different risks and what are how much you're going to do about them. But that has one flaw. It's risk centric. It's looking at the individual risks, and it's not linked to anything in particular. And that's actually not very efficient in risk management terms, because your risk, when you look at yourself, your risk tolerance differs. There are things that you will, you can take a simple thing as driving. Going for a Sunday ride, you will not do speeding because there's no reason for taking the risk that you'll get a ticket and you will have to be pulled over and you have to talk to the officer and your kids get mad and why do you do that and you're breaking the law, Dad, and all that kind of stuff. You won't do that for a Sunday drive. Monday morning, for some other odd reason, you came late out of bed and you have an important meeting at 9 o'clock. Now you'll be speeding, hoping that you will make it. You know that if you're pulled over, you won't make it. But you know there's a 30 or 40% chance that you will go, maybe only 20% chance you'll be pulled over. And if you are not pulled over, you may make the meeting and you will take the chance. So even your own tolerance on something as silly as speeding is differentiated, or is different between different instances. Companies that will be very cautious in investing in Africa will be happily investing in Europe.
Now, one of the things that's very interesting in how you describe the different elements of appetite tolerance and capacity is that normally a lot of companies will think of them in the opposite direction, right? Is that appetite is like the, well, I guess not the opposite, but they think of it as in a different frame, that risk appetite is this really big, high level thing. And then they use tolerance to kind of drill down. And so you're actually doing the opposite, right? And saying that appetite is the lowest level piece, and then to go up from there is tolerance.
Yes, and that is
capacity.
Yes, and that's because the two of us are sitting on both sides of the Atlantic. I'm brought up on the my risk management insights is based on the ISO standard of originally the Australian New Zealand standard, where the big thing is the tolerance, what you can tolerate, and the small thing is your appetite, what you're willing to accept. For some another odd reason, COSO, that defined the terminology for most of the risk management in the US, flopped the two.
Yeah.
I don't know who came first. I don't care. And I have actually written a piece on it for some time ago where I said, please, ISO and COSO organizations, get together in a nice resort, sit down and send out white smoke when you agree on what's tolerance and what's appetite. You're confusing the world.
Yes.
And everybody who's not a risk specialist in particular, when you use opposite definitions of the two.
Agree. I did want to go ahead and just clarify that, because a lot of people, I think, when they heard you define everything, they'd be going, hold on, that's not how I know them. So I wanted to make sure that that was very clear. Now, the other piece that you talked about, though, was, well, there's a couple pieces. So one of them is that concept is taking individual risks and assessing, basically analyzing and figuring out how to approach an individual risk, not the totality of how things exist
Right.
within the company. And there's no context to it, meaning you don't, is this in relation to just a regular running the business, or is this strategic objectives? What is this in relation to? There's no context to
Right.
that.
The
So
least valuable.
So how do you handle that when there is no context?
Well, first of all, if there is no context, there's no reason to do risk management. I mean, if you don't have a target, you cannot fail. And if you cannot fail, why risk manage? I mean, why manage anything? And the dumbest thing I've ever actually seen is a heat map presented nice in red, amber, green, and say we have four red risks. Okay, according to which objective? Vis-a-vis what? What are we going to do about these? Oh, we have to make them amber. Why? There's no. And by the way, how many amber risks do you have before it's as bad as one red?
Yeah.
It's totally. I mean, heat maps are useless on a good day, and it's been documented over and over again. What you have to do is to do quantitative risk management. A lot of people say, oh, well, we don't have quantitative, we don't have the data. Yes, you do. Dark Habit have proven it in several books and then redone it and so forth and do courses. You always have the data. And where it gets really silly is when you have very competent consultants that do qualitative risk management. They say, well, low is less than 10 million, medium is between 10 and 50, and high is more than 50. Okay. And this is a medium risk. Okay, now you've stated that the outcome is somewhere between 10 and 50. Why is that not quantified? To me, it is quantified. And then you can go it deeper, you could do it more precisely and so forth. You can analyze and all that stuff. Sometimes it makes sense to be extremely precise. Other times, a good guess or a discussion between specialists can come up with what's reasonable, easily enough for you to make the best possible decisions. What you need to know, what you need to do and say, okay, we have this initiative. It could be a strategic initiative, it could be next year's budget, it could be a project of building a store in Milwaukee or whatever, doesn't matter. We have this target. Okay, what can go wrong, what can go right, what can help us and stuff like that. And you look at all the uncertainties, you look at all the risks, you look at all the levers, you put the whole thing into a model and say, what's the outcome I can get out of this store? Looking over a 3-year period, what's my net present value? That would be a common way of looking at business projects. And then you calculate and you look at that, and then you take all your uncertainties, put them into a Monte Carlo model. It's not complicated, it's not tricky, there's no voodoo around it. It's just a mathematical process that you can run on any computer using Excel and some add-ons that you can either lend or buy. I mean, some of them are free. And then you can calculate, and suddenly you can see, oh no, it's not about we having 3 or 4 red risks. This is about that project as is has a 20% chance of success. And there's a 50% chance we'll have a negative net present value. Now, try to go to your steering committee and have that approved. It's going to be an uphill battle. Once you've done that, you can start working the plan and say, okay, what are the key risks? What are the key uncertainties that really drives this impact? And start working with these and redo and reiterate your plan into something. And suddenly one day you can say, okay, this is an aggressive plan. There's a 75% chance that we will meet the target, and there's a 5% chance that we will have a negative net present value, which means we shouldn't have done it in the first place. Are you okay? Now you can go to the steering committee and see, okay with that? Yeah, okay, go. And do remember to monitor these 3 or 4 key risks that you have left that you can't do anything more about. But do monitor them, because then we can adjust and react when we need to, if should they materialize. And that's the way you can do decision-focused, value-added risk management. We have to acknowledge the executives we're talking to, they don't care about risk. And it's even worse, they shouldn't. They care about performance.
I was going to say their focus should be on the success of the business.
Exactly. They
The
should
risk
be
is only a little portion of that.
yes, and that should help them, because if I was the CEO of a company and people talk to me and say we have these and those risks, my initial thinking would be, okay, then do something about them. I mean, fix it. I'm not interested in your risks. To me, they're just excuses. You're telling me now where you're going to fail 6 months from now. I don't care. Fix it.
Yeah.
You're aware of it, so yeah, okay. You were hampered by Brexit. You knew it could happen. You're worried about it. You were hampered big time by a pandemic somebody came up with. It's not the first, it's not the second, and it's definitely not going to be the last. How were you prepared? So ask people to get doing something about what you can do when you use this quantitative approach and Monte Carlo simulation, is you can go back to the manager and say, with the plan we have a 70% chance of succeeding and a 5% chance of failing big time. Are you okay with that? This language they can understand. Yeah. That chance, they will say, okay, I will take that chance, or I will not take that chance. And the funny thing about it, going back to this risk capacity thing, is if you're looking at startups run a very risky life. Several, many, most, if not all startups will deliberately take risks that are way beyond their capacity. If this thing goes wrong, we're dead. Yeah, I know. Sure. That's it. We'll do it anyway, because there's only a 20% chance we'll die, which means an 80% chance we'll actually survive and prosper out of this. And if we are only going to do safe things, we can't go anywhere. I mean, even the racing driver Mario Andretti said it decades ago. If everything is under control, you're moving too slow.
Agree. Well, and not just that, but I mean, even when it comes to startups, I mean, and I don't have the specific statistic, like the number value, but an overwhelming number of startups fail within the first 2 years. And I think that a lot of that is because they don't take enough of the right risks. So they haven't analyzed it to say, well, if we take this one and we go after it, this could be the difference between us making it versus not making it.
Yeah.
And having that understanding, which I'm going to toot my own home for a second and say that we have now made it for 5 years. So I think we've now reached beyond the point of being a startup as strategic decision solutions. So, and a lot of that is because we went after things that a lot of people were like, why are you doing that? Because I wanted to be a success. And I knew it would mean taking risks.
I mean, the most brilliant statement about risk management I've ever seen is from an industrial company in Switzerland that stated that we make money by taking chances.
Yeah.
But we lose money when we do not manage the chances we're taking.
Yeah.
And that's what happens. And of course, you have to do intelligent risk taking. You don't just go out and say, oh, this is a good idea, let me go that way. I mean, I have a big business plan here. I want by 2040 to be the world's best manufacturer of spark plugs. Do you think I'll have a business? I mean, the last thing I did was VHS tapes, right? Spark plugs is probably not going to be a thing in 2040.
Yeah, I was going to say, it's all about looking at what is the future of your industry, kind of going back to our last conversation, right? About looking 20, 30 years into the future and saying, what does that look like for our company? What do we need to think about? And being very strategic minded, right?
And go one step further backwards. I mean, take a bank. One of the things they offer you are mortgages, or an investment company. They offer you mortgages. Do you want a mortgage? No, I want a house. But to get that, I need a mortgage. Okay. So what they do is they provide you with housing, or they providing housing opportunities. That's their business. Can they do it in any different way than mortgages? Not yet. Could it be done? Yes, it could be done by some kind of web-based micro lending. I'm not borrowing $100,000 from one guy. I'm buying $10 from 1,000 guys, from 10,000 guys. That means nobody runs a major risk, and I can just go ahead. And they don't have the service capitals and all these other requirements. Can it be done? Well, they're doing it on Uber. They're doing it on Airbnb. They're doing it on a whole lot of other industries where they have disconnected the core delivery. And to me, it's only a matter of time before we see the Uber banking.
Yeah, I agree. I mean, when you think about it, micro lending happens and a lot of other things for small businesses, things like that. It just doesn't happen when it comes to big investments for on the personal side.
Right.
But a business is a big investment and
Yes.
businesses are doing it. So yes, I definitely see transformation there. But so it's interesting. I want to go back to the model that you talked about. So appetite, tolerance, and capacity. Capacity being like if it hit capacity, the company will not survive.
Right.
Some companies and some industries, they have to know that, right? They have minimum capital requirements that, especially if they're regulated, that type of thing. They're going to know that number, like down to the penny.
Right.
A lot of other companies don't necessarily know how to figure that out, or at least not the people on the risk side. So from the risk perspective, it sounds to me like if I was within a company that's not one of those regulated industries, I should go and talk to the CFO's office and say, what is our daily cash requirement for us to be able to survive as a company? What will we need to be able to keep in the bank, right? And
any CFO should be able to, or any CFO organization should be able to, and most will be able to tell you exactly how much can you afford to lose in a single go, and it will not be a profit and loss. It will be a liquidity issue.
Agree. Cash flow.
Liquidity is an art. I was taught once, liquidity is an art financial thing. If it's okay, it's irrelevant. If it's not okay, everything else is irrelevant.
That is correct.
And it ends up, by the end of the day, it's liquidity. You can't pay your bills. Cut. End of. And they can go anywhere. I mean, even your government in the US are discussing lending ceilings to avoid hitting liquidity crunch that they can't pay their bills.
Yeah.
So it can happen anywhere, and say, how much money can we afford to lose on anything before our cash flow says, okay, we're dead.
And so that's actually a really interesting point. So I'm going to delve back into my accounting class from college. So I'm going back a ways. So just bear with me for a second. but on the liquidity side, that means that technically you could have money. The company could have assets. They could have long-term investments. They could have investments in real estate, things like that. It's whether or not they're liquid or not that will determine whether or not the company will survive. Right? Because if they have investments in real estate, that means that they're not going to be able to turn them around, possibly sell them in 15 days or 30 days if they have a huge outflow of cash. And all of a sudden they need to be able to pay the bills. They need to pay their employees. They need to pay all the different bills. So it doesn't matter that you have big investments in real estate or other illiquid assets. I think that's a very good example. A very good example of that is the big box stores. I mean, the retailers.
If you take the very big side, several of your past presidents have closed the country because they couldn't borrow more money, so they couldn't pay their bills. Basically, they were illiquid. They didn't have the liquidity they needed. On the other hand, you can be indebted to up over your ears. If you have the assets to back it, you can have a house that's way too expensive, but as long as you can service the cash flow, it doesn't matter that you owe 3 years of salary out. As long as you can service the cash flow. The day you can't do that, then you're in deep trouble.
Well, and that's really what happened to like the Borders and the Sears and the other stores like that, where they had all of the investments in the real estate, but they couldn't afford to pay the daily bills that were coming due. And so they just like, we're done. We can't do it anymore. They were illiquid.
Now, there's a holding company in China that's in deep trouble. It's going to be the biggest bankruptcy in the world, in the history of the world. They got a 30-day extension on payment on their loans, which was about $30 billion or something like that. That was a payment on their loans. They're the most indebted company in the world. And if they go bankrupt, it'll affect the entire stock market all around the world because they have so many tentacles out. But it's a building company in China.
Wow.
But then again, there will always be. Basically, if you're dead, it's generally as a business, it's generally due to liquidity. That'll be it. And it'll also be due to liquidity if you have a reputational issue that hits you very hard and nobody wants you to buy your products next week. Now suddenly nothing is coming in, it takes 2 weeks, and then you're dead. It will not be the liquidity that drives it, but it will be the mean that does it for you. And of course, it's important to make sure that you have the liquidity that you will need, or as they do in the banking world, make sure that there's a adequately high likelihood that you will have that's what the regulations are, what the banking regulations say. They don't say that you at any point in time should have all the money you're able to be needing, but you should be 99 point whatever % sure that you can service the debt that you have.
Okay. So
it's never an absolute game.
So it sounds like, in kind of as a summary of all of this, when you work your way down, capacity is like your breaking point. Tolerance is we're okay with it. We're prepared to handle it. And
no more than
appetite
this.
is
No more than this.
But okay, but no more than this. If we reach this, we've got to start looking at.
We will start risk managing. We will start doing something.
Yeah. Then everything else becomes like just pure decision management and how you run the business and improving how you run the company, basically.
Yeah.
So I think, and that's a huge shift for a lot of people in the risk world, right? Because they think that everything's about risk management. It's just the amount of effort that you put into it.
But you can take something completely different, like employee health and safety, and say, okay, my risk tolerance is I do not accept anybody who gets killed.
Yeah.
I want to be 99.9% certain nobody gets killed in within the industry. And then you can start talking about what does that mean? Which processes do we have to change? Which safety measures do we have to put in to be able to deliver on that one?
Right.
And that, of course, will help a lot of other risks to be smaller as well. The risk of, should we say, permanent damages and stuff like that, just flow. But you can do it on anything and say, we will not accept this. Other companies, I mean, if you have a huge building company saying we have a zero, we will not accept any death, any casualties, fatal casualties, is I wouldn't say ridiculous, but it's naive, because it's not technically possible.
Yeah.
We're running around with dumpsters and concrete and trucks and all that stuff. Sometimes somebody has to die, and it happens. Of course, you should minimize it. And one of the more elegant phrases of that I heard was from a building company, by the way. They said, we have a zero fatality philosophy. It's not a target to have a zero, because it's not realistic. It's simply out of bounds. It's never going to happen.
Right.
But we will look at every single one of the fatalities that we have and go deep and figure out, what does it take to make sure this never happens again, and take measures accordingly. And we will look at every one of them. No acceptance, no excuses. Whatever happens, we will look at it, because it's our philosophy not to accept. We may still lose 5, 10, 15, whatever people a year, because depending on the size of the company and how dangerous it is. But you cannot be a deep sea fisher or a logging worker and still accept that this is not dangerous.
Yeah.
They seem to be the two most dangerous jobs in the US, which, by the way, is wrong. The most dangerous job in the US is currently held by Joe Biden. Hey, three of your presidents have gotten killed within an 8-year period, and you have had 45 of them. That's 1 in 15. Does any other business kill people 1 in 15 over a 4-year period? I think not. And that's despite the Secret Service and all the brouhaha around it. But yeah, that's the most dangerous job in the US.
Well, it's a good thing I don't want it, so it's okay.
I don't have to consider it, because I can't get
it. Well, Hans, I just want to say thank you so much. I think this has been very enlightening and very helpful for the people watching this. I'm going to post a picture of the model down below the video so that people can see it. I know I'm a visual person. I know others are visual people, so that way they'll have that. And we will have that keynote that this is in alignment with the ISO 31000 language. and not the COSO language. So
Yes.
that way people are very, very clear that they're not trying to align COSO with that
Yeah.
model. So are there any parting words that you would have for everyone watching?
Well, for the risk managers watching, stop talking about risks. Your managers, your executives, they don't care. Talk about the likelihood of success.
Agree.
Work with the likelihood of success and help them be successful by managing the risk, by taking care of the uncertainties, by leveraging the levers that may happen by being prepared. Don't be scared, be prepared. The world is a dangerous place.
Agree. I would add on to that and say nobody likes the story of Chicken Little, but the sky is falling, the sky is falling. So stop yelling that everything is bad when everything is not bad. This company is not going to fail tomorrow. Instead, work to come up with solutions before you go to management, so that they're not just hearing about the problems, but they're hearing solutions. So
Right.
I
And
agree.
you have tons of colleagues that can help you do that. You
Exactly.
don't even have to solve the problem yourself. You can just ask.
That's right. Well, Hans, thank you so much. It's always a pleasure talking with you. And we will talk next time.
Okay.
All right.
Bye.
Bye-bye.